Okay, here are 12 common mistakes that traders make, especially ProAct traders. But more importantly is, how do we fix them? The first one is over leveraging. These are three things that you need to decide before you trade. What percentage of your margin will you trade today within a 2 to 5% total of your total margin? In other words, if you got $10,000 in there, what is 2% or what is 5% of that? And that is the maximum you will put on in the sum total of your trades. We discussed this at length in our bi-weekly advanced class. If you are not getting an invitation to that, go to the website proacttraders.com, go to contact us, and send us an email and we'll get you invited. Now, what percentage will you risk on any one trade? Let's assume you have $200 that you can risk today. Are you going to put all $200 on one trade, or are you going to put it in 2 or 3 different trades, spread it around a little bit? Then what is your maximum daily loss in dollars where you will stop and not trade anymore? In other words, if you say, listen, when I get $100, I've got $100 in losses today, I'm quitting, I'm going to shut the charts down, I'm going to walk away. You have to be willing to limit your risk. Everybody gets in a little funk now and then and can't seem to trade their way out of a wet paper bag. And on days like that, you need to limit your risk to a dollar amount. Number 2, thinking that the PATOs and the HMIs are crystal balls. All indicators, including PATOs and HMIs, are lagging indicators. That means that they tell you what is happening, not what will happen. You should think of them as confirmers, not forecasters. They confirm that the setup is there, but they cannot forecast the future. Lots of things, like the things we're going to discuss in this tutorial, can stop a movement dead. Number 3, not looking at the big picture. Okay, you've got a great 6 aces trade setup going up. However, the red moving average on the wild card is headed down. Instead of realizing that unless this is an actual reversal, it is not going to go too far, instead of waiting for the reaction to the strong side of the trade, in this case it would be down, you enter anyway. You try and stay in instead of moving your stop every time it pulses up, and you take a loss or a break even on the trade. The solution? Wait, 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 and when you get tired of that, wait some more. So here's an example. You enter here due to the white dot on the bottom right there telling you that it's going up, and you have a valid 6 aces trade going into the desert. Okay? However, the trend has shifted down, and the red moving average is confirming that and showing it to you right here on the chart. Alright, the result is you take a loss. By the way, notice this bear flag, which is a clear pattern to the downside. So you should have been aware of that. Number 4, not understanding the power of previous support or resistance. You see a perfectly good setup, a wild card, a 6 aces or a royal flush, and you take it based on the setup alone. You have not looked at what the market did in this previous price area on a larger chart, a 60 or 240. You might even have to go to a day chart. The trade slams into previous support or resistance and stops dead, resulting in a loss for you. Here's the solution. Before trading, always look what the market did before in this area. Big boys are creatures of habit, and they like to do what they've already done. That is the safe way to trade. So, here we go. You enter here due to a white dot on the bottom and a valid wild card signal. The market immediately reverses on you and you lose. What happened? Wasn't it a valid wild card? Sure it was. But let's take a look on the 60-minute chart. Here's the view from the 60, and you can see right over here that you bought right into previous support and the market reversed. The market stopped here before. If it stopped here before, it will most likely stop here again. The better trade was to wait for the 6 aces reversal back into the desert. Waiting is the hardest thing to do in trading. 5. Trading into a T30. You see a perfectly good setup, a wild card, a 6 aces or a royal flush, and you take it based on the setup alone. You have not seen that the T30 is not far enough away to pay the broker and also make a profit. You put a 30-pip stop on the trade rather than following your margin rules of 1-to-1 risk to reward. In other words, if you're going to trade for 30 pips, you can put a 30-pip stop, but you can't put a 40-pip stop on a 30-pip trade. It hits the T30 and reverses the direction and takes your stop out. Here's the solution. Always be aware of where the next T30 is and make sure that if it respects the T30, you will still make a profit after paying the broker. And never put a stop larger than your target. If you do that, you won't be able to trade at the T30s. So here's an example. Okay, there's our white dot telling us we're good to go up. Here's our signal. Okay, wow, we got it, let's take it. We take the trade, and boom, we slam right into a T30, and it rocks back out, and it stops us out right here. And you see it continued on up another 50 pips, but we took it at the wrong place. Number 6, clicking out for too few pips. This is the number one problem for traders. You see a perfectly good setup, and you take it based on the setup. You do not use the pat projector to find the target for this pulse of energy coming into the market. Big boys try and go for 55 pips, and the earlier in the move, the better the probability that they will hit that 55 pips. You click out for 5 to 8 pips thinking you're a winner. You now must be right 90% of the time to increase your margin account. So you won the battle, but you just lost the war. The solution: at the first wild card or 6 aces of the session, use the pat projector and then do everything you can to stay in to the 55 pip limit. So here's a trade right here. Here's the New York Open. So our first trade is right here. We get an arrow and a painted candle up. Okay? You click out here. Why? Because the candle's going the opposite way and I'm scared. The result would have been 55 plus pips. So always use the pat projector so that you can stay in for 55 pips, even though it pulled back right here a little ways. That went ahead and took out the target. So at market open, do not be in a hurry to move your stop. A lot of traders get a trade going, and as soon as it goes up to 8 pips, they move their stop and get stopped out. It's the beginning of the session. You have 2 to 2.5 hours to hit your target. It's not going to hit it normally in the first 5 minutes of the trading session. So leave the stop alone until the market moves out. You can give it 15 or 20 pips here before you move your stop up to break even. Number 7, clicking out for too few pips. Here's another way to do it. You see a perfectly good setup and you take it based on the setup. You do not use the HSI to find the targets. You click out for 5 to 8 pips thinking you're a winner. You now must be right 90% of the time to increase your margin account. Solution: do not make an entry unless you know the exit, and it is an HSI target. Let me repeat this. Do not make an entry unless you already know where the exit is. It is an HSI target. So here I've got the HSI from the bottom here. I just clicked on the bottom and you can see that the R2, R3 are the targets up here. Okay, so the market moves up and it breaks through the R1 headed to the R2 and you click out. Why? Oh, it's going against me, so fear takes over and you click out and you make a couple of pips here. Okay, then you get another shot at it. You take the trade here and you click out. Why? Because it's turning back on you again. Okay, and what did it do? It went to the R3. Number 8, not understanding the power of patterns. You see a perfectly good setup and you take it based on the setup. You have not memorized the statistical probability of patterns, and you have not drawn 200 of each pattern so that you can teach your brain to recognize them. The pattern confirms its statistical probability and moves to accomplish it. But you're on the wrong side of the trade again. So the solution is to memorize the statistical probability of the patterns and draw at least 200 of each one of them in a chart so that you can teach your brain to recognize them. So where do you find them? At www.chartpatterns.com. When you go there, you're going to find this website. It looks like this. And right here are the major patterns that are traded in all commodities, all financial institutions right here. Now, the following patterns, circled in red, are the most powerful for ProAct traders. They almost always produce a wild card or a 6 aces on the break of the pattern, as long as that happens at the right time of the day. So the solution is to learn them, and the only way to learn them is to go into the charts, go into the paths, and draw 200 of each of them. So do one pattern at one day, take a break. Come back 2 days later, do a different pattern. So you teach your brain to recognize them. So this is a bull flag, very, very powerful for us. Here's a bear flag, very, very powerful for us. Here's a descending triangle, extremely powerful for us. Here's an ascending triangle, the very opposite, an extremely powerful one. So once again, here's the bear flag, a clear pattern to the downside. Notice the wild card that you get on the break of the pattern. Here's your dot, there's your arrow and painted candle. You could have anticipated that that's what it's going to happen, because statistically, bear flags with 5 years worth of data always break to the downside. So you could have been sitting here waiting for that trade right there. Number 9, you don't trust what you see. Jerry Rankin has said this: trust what you see and then trade what you trust. If you've done the work and if you have a good handle on what the currency is trying to do and where is it trying to go, which HSI target is it trying to get to, and you have found the barriers that might keep it from doing that, you then should have the confidence to pull the trigger on any valid ProAct trade setup. But if you keep analyzing it, you will talk yourself out of a good trade. So the solution is to do the work. Do your own study on your currency cross. Let's say you love to trade the dollar-yen. Well, then take the dollar-yen as far back as it will go and see what the percentage of wins are on a wild card if you just follow the rules of the setup at the correct time of day. Because you see, trading is about putting statistics in your favor. It's not about being right each time, because you can't be. But you can be right statistically, and that's what counts. If it walks like a duck, looks like a duck, and quacks like a duck, it's probably a duck. Here's the translation. If it sets up like a 6 aces going up, all the PATOs and HMIs are green, you have a green arrow and a green painted candle and room to the target, it's probably a 6 aces going up. You trade outside of the momentum times. You see a perfectly good setup and you take it. But you're outside the 2 to 2.5 hours of the market open. You lose. Why? There's nobody there to drive the currency. The big boys enter their trades during the first 2 to 2.5 hours of the market open, and then they manage their trades afterwards. So the solution is, make this your rule. I will only enter new trades in the first 2 to 2.5 hours of the market open. If you need to, put an alarm clock on your computer and have it ring at 2 to 2.5 hours after the session starts, so that you go, whoa, I can't place any more trades at this point. Do whatever it takes to keep from doing that. Number 11, you think that paper trading is for wimps. To be a successful trader, you need to have made thousands of trades. You can only trade a few trades live each day, so you'll never build a bank of information to know what to do when the trade comes at you live. And the solution to this is to paper trade in the past. How do you do it? Take a wild card and scroll back in time to a place where you have no clue what is happening. Right-click in the right-hand side of the charts and auto-scroll the charts to bring the candles back into view, and then scroll to a market open. Make your decisions to make a trade, and this is important. Write it down, put your stops and your limits and where you entered based on what you see. What is the patterns telling you? Where are the HSI targets? Where's the PAT projector? Scroll one candle at a time and see the results of your decision. You can trade a whole market in less than 20 minutes. And number 12, you trade with your emotions. Trading is a business. Treat it as such. If trading is a hobby to you, then it will always be a hobby. But if you treat it as a business, then you will make business decisions. Do not make decisions based on your emotions. A couple of them might be, I think it's going down. I think it's going to turn here. Or the worst one is, oh God, please make it turn here. For more resources, click here. Now after this is over, you can just scroll back and click this and it'll take you to a link that will really help you. Read The Disciplined Trader. It's a book by Mark Douglas. Here's some more help. 38 steps to becoming a day trader. Again, after this is over, click here and you'll be able to go right to it and download it. The 4 stages of learning to trade. Once again, you can click here. There's the disclaimer. Make sure you read it, and we hope this helps you. Make sure you're in the Tuesday night calls, the Thursday night calls, and the bi-weekly Wednesday night call. Thanks.